Good morning, guys. Again, we'll start with one of the big ticket topic today, financial instruments. Okay. Or maybe before I go to this particular topic, there was a doubt which I got from one of the online student. I thought maybe it could be relevant for all of them. I just like to quickly take 2 minutes and then start this topic. Fine. One of the doubt that came was, you remember Ind AS 38?
Yes.
What is Ind AS 38?
Impairment.
Impairment is 36. 38 is intangible assets we covered. Okay, there was a doubt pertaining to Ind AS 38, impairment of, or rather intangible assets. What doubt was, you remember self-generated intangible assets we classified as goodwill and others. Others are further categorized into research phase and development phase. Correct? For development phase is TIFRC, TIAFRC. If it is satisfied, then we capitalize. Yes or no? And meaning we can recognize as intangible asset. One of the doubt that they came was, sir, where should I show it in balance sheet? The development expenditure. Should I actually show it as an intangible asset, or can I show it as capital work in progress? Like a fixed asset is being constructed means you show it as capital work in progress. Okay. So if you show it as intangible asset, then you'll have to start amortizing it.
Right.
So there is a separate category in balance sheet. This is a Ind AS balance sheet. If you check the balance sheet, there's something known as intangible assets under development. You show such expenditures here. Is it okay? That was a doubt that day. I thought I'll share. Maybe others also might have that doubt. So taking it up. Fair enough?
Yes, sir.
All right. Now, can we come back to today's session?
Yes, sir.
All right. Financial instruments. If you've checked the study material, it's a huge topic. Probably one of the biggest, other than consolidation maybe. Okay. So this particular chapter covers 3 standards. It has 3 standards. One, it covers Ind AS 109. Then we have Ind AS 32. Then we have Ind AS 107. 109, 32 and 107. Basically, the components that we're going to study here in this chapter is covered under 3 Ind ASs. Okay. Now, 109 talks about recognition and measurement. How financial assets should be recognized, at what value. Okay. 32 talks about presentation. How should you show such financial instruments in your financial statements, in balance sheet or anything of that sort. Okay. 107 talks about disclosure aspects. What are the disclosures that are necessary with respect to financial instruments? Okay. So that means this chapter, if we cover, we'll be covering almost 3 Ind ASs. Almost 9, we'll be covering 3 Ind AS itself. Are we fine? Yeah. Okay. So yeah, among this will be the most important one. It'll have all your problems and stuff. Okay. And rest other things will be just concept driven. Not that we'll pay equal attention to everything. Just saying. Are we fine?
So the name of this study should be?
Name, if you check the study material, it's just named as financial instruments. Fair enough? It's covered under 3 aspects. 109 talks about, in fact 109 ka name itself is financial instruments. That talks about recognition. How much value financial instrument should be measured at. Okay. 32 talks about the presentation aspect or classification aspect. Where will you show? You will be shown under equity or financial asset or financial liability, or how classification should be done, presentation should be done. 132 talks about. 107 talks about disclosure aspect. You give certain disclosure in financial statements, in notes to accounts or elsewhere. That is covered under 107. Okay. Are we fine? So we will not be referring the standard anymore. We'll just be referring to as financial instruments going forward. Are we okay? We'll treat this as a chapter. But if you cover this chapter, these 3 standards are automatically getting covered. So far, okay? Yeah. Okay. You want to write down anything?
Yeah.
You want to write this? Okay. Finished. Alright. So before we start with the things covered in the standard, let's have a little background as to why this standard was necessary. Do you remember studying this standard in IPCC anywhere?
No.
Accounting standards? No. Alright. That means in Ind AS specifically, or in CFNL, you're specifically studying this, correct? Let's have a little background as to why the standard came in first. Let's go back, let's roll our days back and go to PUC. In PUC, we used to prepare balance sheet like this, no? Account format, correct? Remember? Alright. So let's take some components. I'm not worried about the heading, I'll just write the components. Okay. First is equity share capital.
Yeah.
which I'll call it as ESC just for understanding. Are we okay?
Yeah.
Then we used to show, like let's say it is 10%. 10% PSC means 10% preference share capital.
Yeah.
Then we used to have some debentures. Let's say it is 12% debentures. Are we okay? Here, in fact, we used to also have reserves and surplus. Correct?
Yeah.
Reserves and surplus. Correct?
Yeah.
Then we used to have current liabilities like creditors. Correct? Outstanding expense, etc. etc. This used to be our balance sheet. I've just taken a few components. Okay. On the other side, we used to have, instead of PPE, back then we used to call it as fixed assets. Now we have become sophisticated. We use sophisticated terms like PPE. Correct?
Yeah.
Then you used to have investments. Then you used to have current assets like debtors, cash, correct, bill receivable or loan receivable. If it is current asset, correct?
Yeah.
Like this, you used to have a classification. Yes, no, sir.
Yeah.
No doubt. I hope no doubt here. Correct. Okay. Now come back to the asset side. Do we have any standard pertaining to fixed assets or PP?
Yes.
We have Ind AS 16, or rather we had AS 10 which talked about it. For investment also we had AS 13 that talked about it. Correct? And even we have consolidation related standards. So to a certain extent investment is covered. We have a standard. Correct? No? So that means this standard gives you how you should measure, how you should classify, what disclosure you need to give. So there is no ambiguity pertaining to these to a certain extent. Correct? Are you with me? Do we have any standard for debtors, cash, loan receivable?
No.
Any standard is there which talks about how they should be measured?
No.
Missing. Correct? How about equity share capital? Do we have any standard? Do we have any standard specifically which talks about equity share capital, sir? How it should be recognized? First time when you issue equity share, how it should be measured? At every balance sheet, how it should be measured? Do we have any standard? Everybody say, once you give, gone. That's it. No. Okay, fine. You feel that. Okay. How about reserves and surplus? Do we have any standard? I understand with equity, that will not change. Okay, first you give, that's it. Reserves can change every year. You create many reserves, you keep transferring from one reserve to other. CRR, DRR, general reserve, capital reserve, everything keeps changing. Yes or no? I mean, this is getting changed year on year. So do we have any standard pertaining to that? How it should be measured? Where it should be shown? No, not that we have read before. Correct? How about preference share capital? Do we have any standard? No. How about debentures? Do we have any standard? How about creditors and outstanding expense? Do we have any standard for all this? All this component of majority of balance sheet are being missed out of the standard now. All this which we have put question mark now, will get covered under financial instruments. That is where a need for the standard came into place. Are we okay? Fair enough, because some of the concepts or some of the components on our financial statements were not covered by other standards. Hence, they specifically brought in something which can fit in these or can comment upon these. We got the need for financial instruments. Okay, that's where this comes in. Now, can we start the topic? This is just a background as to why the standard came in. First, we will know the meaning. This is altogether a new topic for you, so we'll go as slow as possible. Is it okay? So you can ask as many doubts as possible, or you can ask me to repeat as many times as possible. No worries. Okay, I'll have a lot of concepts, so we'll cover them slowly, one by one. Let it take a little time. No worries with this, because entirely new topic, no? So we'll not rush for this. Not that we are rushing for others, but just saying. Okay. All right. First, the meaning. So financial instrument is any contract. Underline the word contracts. That is a keyword. So financial instrument means it has to be a particular contract. And that contract will either result in, listen to what I'm saying, then we can probably write down what they're saying. Financial instrument is a particular contract. Because of that contract, it will result in financial asset for one person or entity, financial liability or equity for another entity. So financial instruments, I'll call it as FI. So FI means financial instrument. Basically, it will only cover those components which are covered under a contract. Because of that contract, it will result into financial asset for one guy or one entity, or financial liability or equity for another entity. You got to remember the meanings. Okay. So I'll repeat that. Financial instrument is a contract that results in what, sir? Financial asset for one company or entity, and financial liability or equity for another entity. Are we okay?
Yeah.
This is the meaning. That means now we need to know the meaning of what? What is financial asset? What is financial liability? What is equity? Yes or no?
Yeah.
So that means we will study the meaning of this again and then we'll come back to the definition of financial instrument. Are we fine?
Yeah.
Okay, so we'll put the second point on hold. Now we'll go to the meaning of financial asset. Correct? Huh?
Okay. Okay.
Alright. So in layman terms, before I have to start anything, means financial asset means anything that has got to do with cash.
Okay.
Financial asset means that anything that has got to do with cash. Cash related. You can just write pet name all this. Anything related to cash is what, sir? A financial asset. So keep this pet name into mind and then we will read our definition. Are we okay? Okay. Financial asset they have defined. They have given in fact 6 components.
Okay.
6 components means your financial assets. We'll see. 1. Cash. Obviously financial asset means what did we say?
Cash.
It is cash related. So that means cash is obviously
Yeah.
financial asset. That means here in bracket you write including bank deposit. Cash including bank deposit.
Even like 3-year bank deposit.
So if you have had any bank deposits for 1 year, 2 years, 5 years, 10 years, or if you have some balance in your savings bank account, or if you have any balance in your current account, all those will be treated as a financial asset because it is got to do with what? Cash.
Yes.
Not necessary that cash you have to receive immediately, sir. It's got to do something with cash. Bank deposit means if you invest in 3 years, you'll get the cash back after 3 years, correct or no? So it's got to do with cash related. So hence cash including bank deposits is your financial asset. Easy? Okay. Second one, equity instruments of another entity. This is specifically being brought in. This is not actually cash related. This is specifically included in financial asset. Okay. Equity instrument of another entity. That means what?
Yes.
Let's say X Limited, that is a company. They have 1000 shares of Reliance or 1000 equity shares of Reliance.
Okay.
Correct?
It's an investment, sir.
It's an investment. X Limited has invested in 1000 equity shares of Reliance Invest. Is it okay? This, what is the definition saying? Equity instruments of an other entity. Which is the entity we are talking about now? X Limited. They have equity shares of another entity. Correct or no? That means this investment for X, will be treated as financial asset because specifically included in definition. Are we okay? Because here if you check the balance sheet, investments already covered, yes or no?
Yeah.
But what investments are covered is related to consolidation. If you have significant influence, 20% or more of investments, then that particular standard talks about. But if you have just maybe like 1000 shares or 1% or petty investments, those are not covered under consolidated relation standard. Hence they got missed out. So we didn't want that to miss out. Hence what they say, equity instrument of another entity also you treat it as financial instrument. Are we okay? Did we get the meaning of subsidiary? We have consolidation for it. They talk about it. Is it okay? Yeah, when we talk about, even though they say it's a financial asset, they say measurement should be as per consolidated standard. We'll take that up later. Are we okay? Okay. Now 2 things we said. We have to kind of keep giving recap on this, okay? Because it's entirely new. What did I say? Pet name for financial asset is cash related. Anything that's got to do with cash. First we saw cash. Cash is definitely a financial asset, but cash here includes your bank deposits. Whether you have money in savings account or current account or fixed deposit for 2-3 years, everything will be still considered as a financial asset. Correct? And another specific thing, though not cash related, specifically brought in, which is what? Equity shares of an other company. They won't call it as shares, they'll call it as instrument in all the standard. And you can substitute it as shares. Are we okay? Equity shares of another entity is also a financial asset. So far good? Okay, third one, can we go? Okay. Contractual right to receive cash or other financial asset from another entity. Contractual, here where the game starts. Contractual right to, third component is what? Contractual right to receive cash or other financial asset from an other entity. I'll give you an example. Perfect, sir. X Limited, Y Limited. X Limited sold goods for 10 lakh rupees on a credit basis. That means X will show this as what? Debtor, because he has to collect the money from Y. Y has to pay this money. That means he will show it as what? Creditors. Yes or no? Correct? Now we are talking from X Limited perspective. Now X Limited has to show this. He has a debtor worth 10 lakh. Yes or no? I'm trying to test whether this debtor is a financial asset. Is debtor a financial asset, sir?
Yes.
Yes. have you already received cash?
No.
No. But here what do you have? Here you don't have cash, but you have a contractual right to receive cash. So that means what? Hence I said what financial asset means something that's got to do with cash. Are we okay? Even though debtors he has not yet paid, here X Limited has a contractual right to receive that cash. That contractual right to receive that cash is also a financial asset. Are we okay?
Yeah.
Any confusion? Alright. Now let's modify this example. We have to receive the money from Y Limited, right?
Yeah.
Y Limited told, take equity shares of my company for 10 lakh rupees. X Limited has sold goods to Y Limited for 10 lakh rupees. That means he has to collect 10 lakh rupees.
Yes.
That means he's showing it as debtor.
Yeah.
What did Y Limited tell in return? Look boss, I don't have cash. I will not give you cash. I will give you my company ka shares. That means what do we have here? Do we have contractual right to receive cash?
No.
We have a contractual right to receive equity shares. And point number 2 only they told, equity shares of another company is a financial asset.
Yes.
Correct or no? Since you are receiving equity shares of Y Limited, it will also be treated as what? Financial asset. Got it? Huh?
Yeah.
Are we fine so far?
Yeah.
Okay, can I modify that example to know whether you understood?
Yeah.
He told, I will give you equity shares, but not of my company, but of Wipro. Doesn't matter whether he gives his company shares or other company shares, because as long as you are receiving equity shares of another company, everything is a financial asset. Are we okay? So far good? So third point is clear. A contractual right to receive cash or financial asset from an other entity. Done now? Can I move on to the next one? To exchange a financial asset or financial liability with other entity under potential favorable to the entity. You say under favorable conditions, you write. To exchange financial asset or financial liability under favorable condition. That much you write. That's sufficient. Cut off all this. To exchange, you'll write like this. To exchange financial assets or financial liability with other entity, put a hyphen and write under favorable condition. Okay. Or rather, one moment. Here you'll write under is there, no? There you bring in one more line. Under favorable condition. That is sufficient. Next line and all you can cut it off. Just this much. You remember it like this. Got it? Yeah. What did you understand by that? Or did you understand anything? We are exchanging a financial asset or we are exchanging a financial liability. We have not discussed financial liability. Let's leave that out. Okay. Either you are exchanging financial asset or financial liability under favorable condition is what they are saying. Can I give you an example?
Yeah.
Or you would like to give an example?
It's like you give inventory or you give your stock to them and they give you like what is it, investment or something.
That can't be considered. Why? I'll tell you in a bit. Inventory is not a financial asset. I'll come to that because it is not cash related. I'll come to that. Good, you're thinking, but it is not a financial. He told the example is X Limited has sold the goods to Y Limited. No, like instead of paying cash, they're giving inventory or they're giving fixed assets. Yeah. Those are not, it doesn't come. They are not financial assets. Why? I'll take it up in a bit. I'll take up an example which is relevant for the time being. Are we okay? Yeah. Okay. X Limited, let's say they have 100 shares of Infosys. Whose worth is, let's say, 10,000 rupees. Okay. Y Limited has, let's say, 100 shares of Wipro. Their worth is 11,000 or their worth, let's say, is 9,000 rupees. Are we okay? Any confusion so far? Now, X Limited and Y Limited are doing an exchange. What exchange they are doing? X Limited told, you take my Infosys ka share and you give me your Wipro ka shares. This is what they're exchanging. Are we okay? Any confusion in the example? No. Is equity shares for X Limited, whose company ka shares they are owning? Infosys ka? Correct or no? That means equity shares of another entity is a financial asset. Yes. That means for X, this is a financial asset. Correct? Yes. For Y also, since they are holding some equity shares of Wipro, it is also financial asset. Correct? Yeah. That means what are they exchanging? Two financial assets they are exchanging. Correct or no? We are talking from X Limited perspective. What is the worth of financial asset they had? 10,000. They are giving away this and they are getting this. Yeah. But what is the worth of that share now? 9,000. You're giving away 10,000 worth of share, you are taking only 9,000. That means it's a happy face or sad face? Sad face, because you're losing out, no? Yeah. That means favorable condition or unfavorable condition? Unfavorable condition. Are we okay? For X, it is unfavorable condition. Yeah, correct or no? or maybe just let's do a thing. We are talking about financial asset, no? So what we'll do a thing, I'll just modify this example as 15 I'll take. Next I'll take 9 when I am explaining financial liability. No. And just I'll take this as okay. We'll just modify this for the time being 15,000. Is it okay? So what is X doing here? By giving away shares worth 10,000, they are getting shares worth 15,000. Correct or no? Now happy face or sad face? Now happy face. For whom? For X, it's a happy face. That means they are getting 5,000 more due to this exchange. Correct or no? Correct? That means it's a favorable condition or unfavorable condition? Favorable for X. Unfavorable for Y. If it's favorable for one, for another party, it will obviously be unfavorable, right? Let's not take unfavorable, we'll stick to favorable. If this is a favorable, then such a contract will be treated as a financial asset. Got it?
So 5K will be treated as
financial asset, yes. Here, what can happen also is, they might agree, we will exchange. They've entered into a contract to exchange. But they are saying, like, we don't want the shares. We will exchange based on market price. Whoever has higher market price, he will settle the other guy. That means they are not really interested in the shares. They are only interested in share ka price, derivative. Remember, you enter into something of a derivative contract where you are not interested in the instrument. You are only interested in instrument ka value, gain or loss. So that particular contract will be treated as what? A financial asset. Are we okay? So let's leave that out. Here, like, this particular contract will be treated as a financial asset.
So all derivatives?
No. Derivatives also will come. Whether you do it, if you give physical delivery happen also, then also it is a financial asset. Okay, because it's done under which condition? Favorable for X, unfavorable for Y. For Y, it will be financial liability. We have not yet come to financial liability, hence I modified that example. Is it okay? Did we understand this so far? Let's have a quick recap. What is financial asset? Something that's got to do with cash. First component is cash, including bank deposits. 2, specifically brought in is equity shares of an other company, any other company, correct? Alright. Third one, a contractual right to receive either cash or financial or any other financial asset. Is it okay? That is also a financial asset. Fourth one, or to exchange financial asset or to exchange financial liability under favorable condition. Meaning if you are making any gain out of that exchange, that is favorable. Such a favorable position we record it as a financial asset. Got it? And if it is unfavorable, we record it as obviously financial liability. That we'll take it up little down the line. Okay? Can I move on? So we have seen 4 conditions. Okay. 6th condition is derivative. In fact, where is it? Derivative, underlying derivative. In fact, they've just kept it as, make this as, okay, fine, it's okay, no worries. Okay, so the next one is derivative. Derivative we'll take it little later. Okay, derivative is a separate section of financial instruments. We'll have to spend some time for it. Okay, for now, time being, you know that derivative can also be a financial asset. It could also be derivative, can also be a financial liability, because when you enter into a derivative contract, you can make a gain or you can make a loss. If you are making a gain scenario, then it becomes financial asset. If you are into loss position, then we book it as financial liability. So this derivative will come under both. For the time being, we'll not spend much time on that. Separate section is there, we'll take it up. For the time being, know that derivative can also be financial asset. Okay? Any confusion? Any confusion or okay? And this one, non-derivative contract which the entity is obliged to receive variable number of equity shares. Underline the word variable. This I'll take it up little later. Okay, in some time. I'll just give you another example. After I cover financial liability, I'll come to this. Okay, this I am putting it on hold.
Entities own equity instruments.
We'll come to that. Don't worry about that for the time being. Okay, we'll come to that. Then we'll see what those are. Okay, so let's have a quick. 4 points are clear now. Only 2 things we have not yet discussed. One is what? Derivative, which we'll be covering in detail, not now, maybe few days down the line. Okay. Another one is a non-derivative contract which entity is obliged to receive variable number of own equity instruments. We'll take that up little later. Once I cover equity, I'll come back to that. Fine, it is related. It can be understood better there. Once you understand that, I will just say reversal of that is financial asset. Then 2 minutes you will get. Time being, let's put this only on hold. Okay, we'll understand that. Got it? So the first portion of financial instrument, is it clear? Financial instrument is a contract that results in financial asset to one company or financial liability or equity to another company. So we saw financial asset, no?
Yes.
Got it?
Yeah.
Easy?
Yeah.
Yes, sure.
Yeah.
Okay, now we saw what is financial asset. Next we need to know what are not financial asset.
Yeah.
That also we should know, no?
Yeah.
Can we look at them one by one?
Yeah.
Physical assets like inventory, PPE, intangible asset, right of use assets are not financial assets. So they are saying PPE, intangible assets, ROU assets, right of use. You remember that right of use? It came in investment property. ROU, inventory, all these are what? They are not a financial asset. Correct? No? Can you tell me why? They said, you can mug it up, they are not financial asset. But why do you think they are not financial asset? What is the pet name I gave for financial asset? Cash related. That means what?
Cash.
By holding that, you should get cash. You have a debtor. Should you have to do anything for that debtor?
No.
Let's say you sold the goods with 1 month credit. For the time being, you will show it as debtor. After 1 month, automatically he will pay. Should you have to do anything else? Should you have to sell the goods once again to him? Or is there any other conditions attached? No, that means what? Just by holding that instrument, you are getting cash. Yes or no? That means they are financial asset. Now think about inventory. You produced 10,000 units of this pen. Automatically you will get cash. Oh, you produced, take 10,000 rupees cash. Will anybody give?
No.
What do you have to do? You have to sell them. Or if you have raw materials, you have to convert them. I mean, you have to do some process. Hence, they are not financial asset. Financial asset means just by holding it, you should be able to get the cash. Are we fine? Equity instrument doesn't meet this definition, but it's been specifically brought in under the financial asset category. Getting the difference? Are we okay? Yes. What did you understand?
Financial assets are cash related assets.
Basically, by just holding them, you should be able to generate the cash. But here, in case of tangible assets like PPE, when will you generate the cash? By using it. That means you have to do something. That means they generate investment inflow opportunities, but just by holding them or by using them. Hence, they are not financial assets. Got it? So, hence, tangible assets, intangible assets, ROU assets, inventory are not financial assets. Got it? That's what they have given there. Or you want me to read? Control of such physical assets, ROU assets, intangible assets create an opportunity. Just by holding them, will you get the cash or an opportunity is created? An opportunity to generate the cash is created, but it does not give any right to receive the cash or financial asset. Just by holding them, you don't get cash. Okay? So you can just write that as in your notes there, just as a remembrance point. Just by holding PPE, inventory, intangible asset, company won't get cash. Can I write it that way? Company won't get cash. Hence, not financial asset. Hence, it is not financial asset. Financial asset, can I call it as FA going forward? FA is not fixed asset, sir. We don't call it as fixed asset anymore. We call it as PP. Anywhere in your books, if you see FA, it is financial asset. Okay, now? Are we clear with this? So you remember why that example we didn't take, which you gave for exchange? Because they are not financial assets. Fair enough. Only if you, this point covered only what? Only if you exchange financial asset or financial liability under favorable condition, it is a financial asset. This point.
Is it like commercial substance?
Generally they do have, man. Generally they have. This standard doesn't really mention anywhere about commercial substance. It is, so that means literally interpretation whether transaction has or it lacks, we should take it. But naturally most of them, because you are exchanging one with the other, no. So 99.99% of them, they will have commercial substance.
Only then they can gain from it, no? Favorable.
Correct. That way indirectly it gets covered maybe. Fair enough. Yeah, I think you are right in saying, pointing out that, yes, because that gain scenario, I think commercial substance should be there. Fine. Correct. Can I?
Yeah.
Good one. So now we got this. Okay, I'll give you another example. Prepaid salary, prepaid expense, or let's take prepaid salary. We are currently, let's say, in April month, or let's say we are in May month. Okay, June month ka salary, that is next month ka salary, you paid off in May only. Can you book it as an expense in May?
No.
Because June month ka salary you paid in May, so you will show it as prepaid expense. So the journal entry will be prepaid expense account debit to cash or bank. Correct or no? That means you are debiting prepaid asset. If you remember golden days, prepaid asset used to show it under current assets. Can I treat prepaid expense or prepaid salary in my example as a financial instrument or a financial asset?
It's not generally the option, right to receive cash.
It's, first of all, is it cash?
No.
Now let's test all the 6. Is it cash?
No.
Is it bank deposit?
No.
First condition ruled out. Second is what? Equity instruments of another entity, which is not. Third one is what? a contractual right to receive cash or other financial asset. Here, you gave salary, no doubt, but what are you getting in return? Some service. Are you getting any cash in return? Or are you getting any equity shares in return? No, you are getting some goods or service in return. Here specifically you are getting a service. Hence they are not financial asset.
Okay.
Are you getting it? Because employee will work for you. That means in return, what are you going to get? Will he give the cash back or he will give you his service? He'll only give service. That means if you're getting any service in return, they are not a financial assets. Getting it? Okay. I'll give you one more example. You paid advance to your creditors.
Okay.
You want to purchase some goods. So creditor told cash, first you have to give me advance, then only I will send the goods. You gave the advance in May, but he will give you the goods only in June. That means in the month of May, what journal entry will you pass? You can't treat it as purchases because you have not yet given it. It's just an advance. So the journal entry will be what? Advance account debit to cash or bank. Advance to suppliers account debit to cash or bank. Yes or no?
Yeah.
I mean you are debiting.
Yeah.
In your golden days you used to show it as what? Current asset you used to show.
Yeah.
Can I treat this advance to supplier as a financial asset? Again, don't apply. Just stay within that ambit of definition. Are you gave an advance, no doubt. In return, what are you going to get from that supplier? Cash or goods? So that means you have a contractual right to receive what here? Goods. Are goods financial assets? No, that means what? That advance to supplier is also not a financial asset. Is this okay so far? Fair enough. Suppose contract got cancelled. Then you had a contract so that you will pay advance now. Next month he will supply goods. Contract got cancelled. Now that advance becomes refundable. That means now it will become a financial asset because now you have a contractual right to receive not goods but cash. Are we fine? Hence I said financial asset means anything that has got to do with cash or cash related. Only one component is not cash related, that is equity instruments of another entity. Hence they brought that specifically into the definition. Because just by holding some company share you will not get cash. Because there is no dividend obligation. Nor there is any repayment obligation. But this is specifically being brought in because it didn't cover under any other standard. Hence they have specifically brought in this into the definition. So that it gets covered. Okay, fair enough.
ESOP and all.
We'll cover. The ESOP and all will not be covered here because we have a separate standard. Ind AS 102, share-based payment.
Because it says contractual right to receive cash or financial asset. And that can be equity also.
Correct. Which one?
So,
no. ESOP when you give, you mean to say from employee perspective.
No.
From company's perspective, you gave ESOP. Correct. What are you going to get? Are you get shares? No, you will get only service. No. You're giving, your employee will give service for you in return. Again, but in fact, those contracts are covered under Ind AS 102 share-based payment. We have in AS and IPCC level, you had a guidance note. You didn't have any accounting standard for if you have done this. In your ESOP accounting, you have done in IPCC also. But that was covered under guidance note. You didn't have any accounting standard. Ind AS, there is a specific Ind AS 102 share-based payment. We'll cover it there. Okay, so since that particular standard is specifically talking about those adjustments, it will not be covered here. It will be there.
So I'm holding shares of let's say Wipro, and Wipro comes out with a rights issue.
We'll see.
That will come in this?
For you, yes. You are holding, no? Yeah. I mean, you are holding equity instruments of another entity. His example is, sir, I own, okay, H for Hrudin, no? So let's say Hrudin. Correct? Am I spelling it right? Whatever, sir, right? It's okay. It doesn't matter. Naam mein kya rakha hai, right? Alright. So he holds what? Let's say you are holding 100 shares of Reliance, correct? Yeah. And Reliance comes out with a rights issue or bonus issue or anything of that sort. Correct? Yeah. That means what are you going to get?
Shares.
Because of this rights, again you're going to get shares only. Yeah. That means you'll still get what? Equity shares of another entity. Yeah. If you're holding equity instruments of another entity, definitely it is a financial asset. Here only they told of no. Equity shares of another company, if you're holding, it is definitely a financial asset. So specifically brought up.
So you recognize that?
Only when the right to receive that shares gets established. When you give the right shares.
But that only if you pay with
then only you'll record. Correct? Oh yeah, you can't say that because with rights, if you remember, you have three options. Either you can exercise the right or ignore or sell that right as a coupon to somebody else. We used to call that as right renounced, right subscribed and all in IPCC. It depends on what you're doing. If you're buying the shares, then definitely it will come. Otherwise, no, it will directly go off as income. Everywhere it will come. But we can't pass any journal entry for a bonus because it is given at free of cost from your perspective. You used to do investment accounting. used to put up that face value, number of shares, cost column, columnar format. Man. Only used to put it in a number of shares column. You never put bonus shares under cost column, if you remember. Anyway, some of them would not remember. So let's not go there and all. Are we okay? So let's leave that out. Are we fine? Hope I've answered your example. So if you are holding equity shares of another company, definitely it is a financial asset. Done now. So we learned one more thing here under what is not a financial asset. What are not financial asset? Just to recap. If you are holding, is a PP a financial asset? No. Inventory is not a financial asset. Intangible asset is not a financial asset. ROU assets are not financial assets because they only generate cash flow opportunity. Just by having them, you don't get any cash. Are we fine? Hence, they are not financial assets. Got it on? And for prepaid expense, advance given to supplier and all. Here also, we have a right to receive, but we don't have right to receive cash. Here we have a right to receive goods or we have a right to receive service. Hence, they are also not financial asset. Done now? Anything else?
Prepaid expenses, this expense can be for anything as well. Like we could prepay for multiple things.
Yes.
For example, I prepay for my employee credit cards. So that would be a financial asset because they are going to get cash out of it.
If you are getting the reimbursement out of it. So basically it could be any prepaid expense. So employee expense you bore and later you are asking the employee give the money back. If you are taking the money back from the employee, that means now you have a contract to receive cash or right to receive cash. Wherever right to receive cash is established, such contracts are financial assets. Yes, definitely. If you have a right to receive cash, it's definitely a financial asset. But if you have a right to receive goods or a service, it is not a financial asset. Getting it? So I just to give one prepaid example. Here you have structured like this. So hence in your example, if you're asking the employee to refund that money back, then definitely it is. Staff loan is a financial asset. Why? You gave a loan, periodically he'll give you the money back. That means you have a right to receive the loan back. That means it's a loan receivable for you, yes or no? So staff loan for a company is a financial asset, definitely. Because you're not getting any service, though you're getting a service, this is a separate arrangement, yes or no? That way. Move on. This is related to financial liability. Maybe just now that we have spent a little time, maybe we'll read it and see if we can figure this out. Okay. We have any deferred revenue or warranty obligation. They are not financial liabilities. You remember advertisement expense and all, we used to treat it as deferred revenue expenditures. Okay. Those are not. Because what? You don't have any contractual right to receive cash. Fair enough. Hence, they are not financial assets. Like you have something known as warranty obligations here. Okay. Or maybe I'll do a thing. I'll come to this warranty under financial liability. It'll be better because it is not related to financial assets. Okay, now? So I think this is fine. So by now I think we have got a reasonable understanding as to what financial assets are. Got it? Okay. Now can we test whether have we really understood? With an examples. So let's start question number 1 then. A Limited makes the sale of goods to customer at a credit days of 45 days. I mean, it will result into debtors. I mean, so automatically I think you know the answer. Well, still for customary we will read out. Customers are entitled to receive a cash discount of 2% per annum if the payment is made before 45 days and interest at 10% per annum if charged for payments after 45 days. So before 45 if you make, you will get a discount. After 45 days if you make, you will be charged 10% discount. On the 45th day if you make, no discount, no interest. It's a break-even zone. Yes or no? So they are saying company does not have a policy of selling its debtors and holds them to collect contractual cash flows. Actually, this is related for method. Leave that for the time being. Evaluate the financial instrument. So basically, they're asking whether it's a financial asset, financial liability, or equity. So what is this now for this company? We have a debtor. Debtor means we have a right to receive cash. Once right to receive cash gets established, obviously they are what? A financial assets. Are we okay? This financial asset is specifically recorded at amortization method. There are 3 methods: amortization method, FVOCI, FVTPL. This is measured at amortized cost. I'll tell you a little later why. Are we fine? Let's not go there. We are only discussing the definition for the time being. Okay. Maybe once I do the method, you can come back to this question to ascertain why this was at amortized cost. You will be able to tie out that. Are we? First of all, here as per this question is concerned, what is the solution? It is a financial asset. Correct? Fair enough? That's all. It meets the definition of financial asset. Just underline that. Which method you measure or not, we'll take it up later. Easy. Can we move on to the next one? Z Limited, a company, makes sale of goods to the customers on credit. Goods are carried in large containers for delivery to be delivered to for delivery to dealer's destination. So like we are sending the goods in containers. Maybe liquid item probably it is. all dealers are required to deposit a fixed amount of 10,000 as security for the containers, which is returned, underline the word, which is returned only when the contract with the company terminates. The deposit carry 8% per annum interest, which is payable only when the contract terminates. So we are giving interest on our deposits, but not now, but only after the contract ends. If the containers are returned by the dealers in broken condition or any damage caused, then appropriate adjustment shall be made from the deposit at the time of settlement. So if there is any damage, we will not give you full deposit. We will deduct that damage from the deposit and pay you only the balance. How should this deposit be treated in the books of the dealers? Dealers, not the company. There are two guys. Yes, no? Company and dealers. Correct? Some company is selling the goods. Correct? No? In container. And dealers are supposed to make a fixed deposit. Are they supposed to make a deposit? Correct or no? Any confusion? Yes sir, no sir. For a company, this deposit is refundable. Correct or no? That means it's a liability or an asset, sir? It's a liability because they have to refund. For a dealer, after the contract ends, will they collect the deposit back?
Yes.
Yes, that means it's an asset.
Yes.
So we are talking from dealer's perspective. Their specific question is it a financial asset? You just have to tell me the answer. From dealer's perspective, is it a financial asset? Leave this portion.
They're going to get cash later.
So financial asset means what? Cash including bank deposits or equity instruments of another entity or a contractual right to receive cash or other financial assets. Yes or no? Or to exchange financial assets or financial liability under favorable condition. Then derivative, then variable number of shares. Last two we have not yet taken up. So here which point is getting triggered? We have a contractual right. The dealer has a contractual right to receive the cash back.
Yeah.
Not now, but he will get it. Yes or no? Should he have to do anything for it? Or just by holding deposit, he will get the money back? I mean, what is this? What is the nature of this deposit now? It is a financial asset. Why? What will you quote? How will you answer this question if it comes to 2 marks? You will write the definition of financial asset once. Okay, may not be necessary for all the 6. Just call out 2 or 3. Specifically, you need to call out which one? A contractual right to receive cash or financial asset. That point has to compulsorily come. Then what will you write here? In the present scenario, the dealer has a contractual right to receive the cash from Z Limited. Hence, it is a financial asset. Yes, sir. Should I have to show the presentation or manageable? Just one line you have to write and give the conclusion. Correct? No? Just underline the last line. Hence, they meet the definition of financial asset, which is carried at amortized cost. Leave amortized cost for the time being. We have not yet discussed the method. So, let's not go there for today's session. Today's session, maybe we will not be able to cover it. It's okay. No problem. Those are all simple ones. Should be able to manage them. Any doubts so far? Are we going fast or pace is fine? Everything is going in? No, please. Move on to the next. Question number 3. A Limited issues a bond at a principal amount of CU per bond. Maybe this question is from IPCC or maybe from IFRS books. It's a currency, sir. It should be INR. Not yet made the correction. All this is a study material question. What was there? I will just brought in. Okay. CU, it's a currency. No. CU means which currency? You have any idea? No. Some country currency is CU. Okay. Think for when you read the question, think like INR only. Okay. INR 1000 rupees. Okay. The terms and here we have given a bond. Okay. This company has issued a bond and for 1000 rupees per bond. I mean the face value they're saying. Face value is 1000 rupees per bond. The terms of bond require annual payments in perpetuity at a stated interest rate of 8% applied to the principal amount of 1000. Correct? No, interest is always calculated on principal only. As far as payout is concerned. Assuming 8% to be market interest rate for the instrument when it was issued, the issuer assumes a contractual obligation to make a stream of future interest payments having a fair value of 1000 on initial recognition. Evaluate the financial estimates in the hands of both holder and issuer. Holder and issuer. 101 things they gave. Financial asset ka. We have not yet gone to financial liability ka. So now, if you purchase debentures of another company, so you think from that perspective and tell me, you purchased the debentures of Tata Limited. What is it for you from your perspective? Because of the debenture, what do you get? Periodic interest you will get. Correct or no? And then after the term, if let's say the term of the debenture is 10 years, after 10 years what will happen? Debentures will be redeemed and you will get your money back. Correct? Whatever redemption could happen at face value, no premium or discount, but you will get your money back. Yes or no? That means what here? what we have what here? The holder has what here? He has a contractual right to receive cash, correct? Or financial asset. Here mostly it will be case of since you are receiving cash here, we have a contractual right to receive cash. The moment we have contractual right to receive cash for a holder, what it is? It is a financial asset. For the guy who invested, it's a financial asset, yes or no? Think from company's perspective. They have a contractual obligation. If they have obligation, it will be a financial liability. We'll discuss this financial liability in detail. Just for the solution sake, we have written it. Are we okay? One guy is receiving cash means other guy is paying cash. For the guy who's receiving cash, it's a financial asset. For the other guy who's paying cash, it's an obligation. And we call it as financial liability. We will go through that financial liability definition also. Next only it is there. Since solution had it, I've just covered it. Manageable. But this is perpetuity. That means what?
Until the end of the
End of. That means there is no question of redemption. But still you will get interest, no? That means you have a contractual right to receive cash, no? Still it is what? Even perpetual instruments are, these are known as perpetual. You can call this as perpetual debt instruments. Perpetual debt instruments. We no more call debentures and all this, sir. We use fancy terms. Debt instruments. They are nothing but what? Debentures. Okay. So these are perpetual. So though you may not get your principal back, you will get interest throughout now. So maybe they are giving you that high in interest that your principal also in a way is getting recovered. So you have a contractual right to receive cash. So definitely a financial asset. Okay now? With this financial asset, we have done the definition. We have done all the problems. Like this we'll be going concept questions. Like this we'll cover the whole topic. That's a structure to this. Yes sir.
So what if we get partial cash flows and partial services?
Partial service. Service is not a financial asset. Actually better question would have been service will not be probably thing. What if you're getting equity? What if it is converted? That would be a better question.
Then both will be financial.
Like there are some, you are just probably 2-3 days ahead of me. There it will come, or maybe tomorrow it will come, or we'll see. Yeah, they hire. What if it's a combo offer? What if it's like a convertible debenture, sir? On convertible debentures, you get interest. That means you have a contractual right to receive equity share. Shares. Also, you will receive equity shares. So, from holder perspective, it is definitely financial asset because either he will receive cash or he will receive equity shares. Both are financial asset. But from company's perspective, obligation to pay cash is a financial liability, but the other portion represents equity. So what to do is there. We'll come to that. We'll just have to wait for it for some time.
What if combo of financial and non-financial assets?
If it's a combo of financial and non-financial asset, this covers only financial asset. Record only financial asset portion. This non-financial asset, you see which standard gets triggered and accordingly. If it is PP, then apply PP ka standard. Like this, you'll have to do. This covers only financial asset. Other than financial asset, this doesn't talk about. If it's a combo, you have to split. No other book.
So you find using the other standards the value of
correct. Then you'll have to apply. If it is PP, then you'll worry about what is DAC, DSR, subsequent recognition, cost model, revaluation model. All this you'll think about and accordingly do the account. Here only financial asset ka, financial liability ka, equity ka accounting is defined. Disclosure is defined. Measurements are defined. Other than that, everything other standards. Fair enough? Easy so far? Can we go for the next one? So what do you think is financial? Next is financial liability. Alright. So now we don't have to study this. We can construct our own definition. What is financial asset? First cash. Here you don't say negative cash. Negative cash will not come here. Okay, overdraft will not. That comes separately. We'll see. Are we okay? Then it's what? Leave out the cash. Second one is second was equity shares of an other company. That you can't. Your own company equity shares, you can't call it as a financial liability. Actually, there's a star mark. There's an exception to that. I'll take it later. Leave the first two conditions out. What is the third condition? There it was contractual right to receive cash or financial asset. That means what will be here? Contractual obligation to pay cash or deliver cash or any other financial asset. You can't deliver financial liability, To settle financial liability, either you have to give cash or some other asset in return. That means what will be the first component? Financial liability is a contractual obligation to deliver cash or other financial asset to another entity. That is one. Correct. Next, what was the fourth component there under financial asset? To exchange financial asset or financial liability under favorable conditions. Here it will be exchanging financial asset or financial liability under unfavorable condition. Remember that example here? How does that share? Well, one moment, it's loading. One moment, it is loading. File size is a little big, no? Here for X there is this exchange, correct or no? For X it's a financial asset. For Y it was unfavorable. That means for Y it will be what? A financial liability. That's what they're saying here. Got it? Are we fine? Okay. Or it could be derivative. What was the fifth component we said? Derivative or variable number of equity shares. This we will take it later. I told derivative could be either financial asset or financial liability. We will not spend. First we need to know the meaning of derivative and all that stuff. That is taken up as a separate section altogether. Okay, so don't bring that in here. But just know that derivative can either, it can't be both, sir. Either a financial asset or a financial liability. And it could change. First month it could be gain. Gain means you'll record it as financial asset. Next month it could be a loss. That means you'll have to, you'll be say it as mark to market accounting. That one, you'll have to do that. Fine, we'll cover it. Separate section it is. So let's leave that out. This point, if you remember, I put that on hold. For a financial asset also, it's the same thing. Non-derivative contract for which entity is obliged to deliver a variable number of equity shares. Same point was also there also. There, what was the wording under financial asset? Non-derivative for which entity is not obliged to pay, obliged to receive, right to receive variable number of equity shares. Okay, underline the word variable. The variable is key. In fact, it's also been given in bold, but just underline that. Are we fine? I'll also put this on hold now. I'll cover equity. Once I say equity, that those 2 points will get covered for you. Only one point we have kept it as hold for the time being. Okay, now. So financial liability is fine with you. So just to recap, what is financial liability? A contractual obligation here to either pay cash or any other financial asset, or to exchange financial asset or financial liability under unfavorable condition. Then derivative or non-derivative contract in which you are giving your own company ka equity shares, but variable number of equity shares you are giving, hence it should be classified as financial liability is what they are saying. That we will know the meaning little now, just maybe we'll solve few questions and come to that. Fine now. Now just like financial asset, now can we take up financial liability ka questions?
Yes,
Question number 4. Can I?
Yeah.
Start off. A Limited, the company, makes a purchase of steel for consumption in the normal course of business. So inventory, they purchased some goods. Okay. Purchase terms provide for payment of goods at 30 days credit and interest at 12% per annum for any delay. So we have purchased the goods. Have you made the payment or we had to make the payment? That means in our books we'll show it as what? Creditors. Correct or no? Creditor means, is this creditor a financial liability?
Yes.
Yes, because which criteria you will call out? How will you answer this question?
Obligation to pay cash.
This is first you will say a financial liability is a contractual obligation where we have an obligation to deliver cash or any other financial asset. That point portion you will write correct as first paragraph. Second case, what you will say? In the present case, you want me to show? It's okay?
Yeah.
In the present case, A Limited has a contractual obligation to pay for the goods purchased. Hence, it is a financial liability. Okay? Measured, they are saying. In fact, they didn't give the measurement here. We'll see. 3 methods which fits in. Actually, ACM only, amortized cost method. We'll see. That's okay. So, the only intention of this scenarios is to identify whether it's a financial liability or not. We'll stick to that. Measurement, don't worry. How it is recorded, to what amount, and going further we'll take. So we'll go little by little here. So that because it's altogether new thing, no? So let's not jump everything. And everywhere it will become full chow chow baat. Easy. One part we'll split and study. Later we'll do full-fledged problem where everything will be covered. So there last May we'll also have to find out whether it's a financial asset. If it is financial asset, how we should account it, how we should disclose it, what and all changes will happen. Like that, those sort of problems will come. There you'll be able to tie out everything. Any doubts or move on? Yes.
What about capital creditors? Capital creditors.
What about capital creditors? So you gave what, sir? Can you give me an example?
We gave them advance for, let's say,
you gave an advance to
buy a machine or
machinery. Okay. So that means what? In return, what are you getting?
they're getting PP.
We're getting PP. So definitely from other perspectives, it's not a financial asset per se, but you have an obligation. I'm not talking about the holder perspective. I'm talking about the company who's making the payment. So just don't worry about the scenarios. What is the financial liability? Obligation to pay cash. Do we have obligation to pay cash?
No.
Company does not have a.
No,
they purchased the machinery, you said. In fact, give me a scenario maybe. What you're trying to say. I'll just
we made a down payment of contract for getting a machine.
A Limited, we'll call it.
They made a down payment
down payment, we'll call it as DP. DP of 1 lakh they paid. For what purpose?
So that they'll get a machinery after let's say 1 month.
They'll get a machinery. Okay. So for machinery purchased.
Yeah.
Okay. Let's say machinery cost is 10 lakh.
Yeah.
So machinery cost is 10 lakh. They have made a down payment of 1 lakh rupees. That means balance is there.
Yeah.
Balance is how much, sir? 9 lakh. We have to pay this or not?
Yeah.
We have to pay. Correct or no? That means, does this A Limited have an obligation to pay this 9 lakh?
Yes.
That means what sort of an obligation we have? We have a contractual obligation to pay cash. That means for this 9 lakh will definitely be treated as financial liability. Don't apply financial asset ka standard here. Okay, those were what? Plant and machinery is definitely not financial asset. And from that guy's perspective, it is not a financial asset. Correct? But you are restricting yourself to financial liability. No? Here we have a contractual obligation to pay cash, means it's a financial liability.
Okay.
Correct? Now you have to check whether should we have to pay anything. In this case, if you have to pay even some other asset, instead of paying 9 lakh in cash, we said take my debtor. Debtor is a financial asset. That means we have a contractual obligation to deliver another financial asset. Still, it is a financial liability. As long as obligation exists to give either cash or any other financial asset, definitely classification will be financial liability.
So what if you
How recording and all happen, don't think on those lines. Journal entry, amount, don't worry. There are method. You have not heard about the method and all. Hence, I'm asking you to restrict. Whatever you have done now, till now, that method will not work. There are specific methods called out. Okay. Journal entry, don't freak out for the time being. We'll take it one at a time. Example, if you have any doubt, build it. It's okay.
So what if we, instead of down payment, we made an advance payment full 10 lakh?
Full payment you already made.
And we have
How does an advance payment now? Matlab, you have not received the machinery yet, you're saying. Okay.
So here our right to be is to get the machine.
So you have a right to receive machinery. Is machinery a financial asset? You can't show it as machinery.
Okay.
Because think on the other side also. If you show machinery as financial asset, where will Ind AS 16 fit in? No PP, no. Correct? Since PPE are not financial assets.
Okay.
Because then what will you apply? Correct? No. Because every company will buy a machinery. If you say those are also financial assets, then PPE standard whole thing you can take off now. So hence inventory we have a separate standard. Ind AS too. Intangible assets we have a separate standard. Machinery also we have a separate standard. Hence they have left out. Or more logical way why they have left out is we don't have any contractual right to receive cash there. We have a contractual right to receive only the goods, and goods are not financial assets. Okay. Fair enough? So that's it. So, but we are not talking about financial assets. Here, your example is more towards financial liability. Okay, now? So, hope your doubt is sorted. Can we move on? Okay. So, I think we already written answer for this, no? This is a financial liability. Last time we underlined that. Can we move on to the next? A Limited makes a borrowing for INR 10 lakh rupees. They have taken a loan. There itself, I think things are getting sorted. But still, we will read. Sometimes the structure slightly differently. With a bullet repayment of 10 lakhs and annual interest rate of 12% per annum. That means what, sir? Bullet repayment means one go. Bullet, no. One shot. Okay. That means what? You have taken a loan. Correct or no? If you have taken a loan, means you have to pay principal and your interest you have to pay. So they are saying principal we are not paying annually. Principal in one installment. When the loan term is over, no, we will pay off principal. Entire 10 lakh we will give in one shot. That we call it as bullet repayments. But interest they are saying is annual. That means every year you have to pay interest, but principal you repay off in one go or one installment. Okay, no? Does that make sense? Can I move on now? And now the company defaults at the end of 5th year, and consequently a rescheduling of the payment is made at the beginning of 6th year. Okay, first to stop there only. Something is happening at the end of 5th year. So we'll talk about year 1 perspective. Because something is happening is year 5. Year 5 will not worry. Okay, year 1 is it a financial liability according to you? Leave the other portion just by looking at this portion. One I put in brackets. Can you tell me, is it a financial liability for A Limited? They have taken a loan. I mean, they have a contractual obligation to pay principal and interest. I mean, they have an obligation to pay cash. I mean, is it a financial liability? Yes. Okay. Subsequent may, if you're doing any alterations of the loan, interest rate increased, principal reduced, all these are modification accounting, it will come. Okay. They will also be treated as financial liability. Are we okay? They are giving you certain examples of this modification accounting. Okay. I think let's not go into the accounting per se for the time being. Study material question, but you will be able to get that. Okay, because we have just started, no. So full-fledged taking up doesn't make sense for the time being. Got it? Any confusion? Or maybe just the interest. We will just read the question once. Okay. At the end of 5th year, the company the company defaults at the end of 5th year, and consequently a rescheduling of the payment is made beginning of 6th year onwards. Meaning 5th year they had to pay off. Okay, since you have defaulted it. Okay, so they've done some rescheduling. Company is required to pay now INR 13 lakhs at the end of 6th year for one-time settlement in lieu of defaults made earlier. Analyze the differential amount to be exchanged for one-time settlement. Analyze the differential amount for one-time settlement. Or can we just maybe look at the solution? Is it okay? First of all, for year 1, is it a financial liability?
Sure.
For year 1, for A Limited, loan is a financial liability. Yes or no? Yeah. This is the first point you have to write down. Done now? Yeah. Year 5, something is happening. You defaulted. Yes or no? Yeah. And they are saying now give me the payment within 6th year. Yeah. Correct or no? Yeah. Or which year is that? 1 moment. Okay, we are defaulted at the end of 5th year. Yes or no? Yeah. That means year 1 ka interest, year 2, year 3, year 4, year 5. 5 years of that. Check the board. Up to 4 years, you have to pay only interest and you are paid because principal is a bullet repayment. Yes or no? That means any default up till here? No. Year 5 you defaulted. That means did you give interest, sir? No. Did you give interest or pending? Didn't pay interest. Didn't pay interest. Yes or no? That means now what do you think will be the loan balance? You have to pay 10 lakh. 5th year interest did you pay? No. Or maybe just just to give you PUC perspective, I'll just tell you. Actually, I need not do this, but maybe some of them will be still a little skeptical. I'll just prepare a loan account. Next to do is in loan ledger, no? What is the journal entry, sir? Initially. Initially. Just show you for one. So the journal entry is bank account debit to finance. Henceforth, we will not call it as loan. We'll call it as financial liability hyphen loan. Are you comfortable with that? Okay, so that means here the heading will be financial liability hyphen loan. So what will be the journal entry? Year 1 beginning. It will be by bank. Yeah. Bank account debit to loan 10 lakhs. Yeah. End of year 1 you have to pay interest. Yeah. Interest ka journal entry here will be what? Interest to loan. So interest account debit to financial liability loan account. Correct? No? That means year 1 end you will pass what entry? By interest. Yes or no? Yeah. Interest to what rate they said? 12%, correct? So 12% of 10 lakh is 1,20,000. Yeah. 10 lakh cut 12% is 1 lakh, 1.2 lakhs, correct? Year 1 you're supposed to, supposed to repay any principal or only interest? Means it will be repaid. What will be the journal entry for repaid? Loan repaid. Financial liability loan account debit to bank how much? 1.2 lakh. That means year 1 ka closing balance will be what? To balance carry down 10 lakh. Yes or no? Yeah. Correct. That means every year same entry will come with same amount. Yeah. That means loan balance also will be how much? 10 lakh. 10 lakh only. Correct? Now I'll not do for all the 3 years. You got the funda, no? That means I'll write here FL loan account balance at beginning of year 5. At the beginning of year 5, how much do you think will be the loan? At the end of year 4, it will be 10 lakh. Beginning of year 5, it will also be 10 lakh. Yes or no? Yes. Then 5th year ka interest will be charged. Yes. 5th year interest will be again 1.2 lakhs. Yes. Correct? Yes. Did you repay this 1.2 lakh or did you default? You defaulted. Now the loan balance will become 11.2 lakhs. Yes or no? Now do you think 6th year interest will be on 10 lakh or it will be on 11.2 lakhs? Since you defaulted, 6th year interest will be 11.2 lakh into 12%. Correct or no? How much will be that? It will be 1.344 1.344 lakh. Yes or no? Yeah. That means what is the loan ka closing balance? 12.5. Loan closing balance at the end of at year 6 end, can I write? Year 5. Year 6, no, 6th year. 6th year we are settling, no? Hence I am taking 6th year ka end balance what? Are we fine? Yes. How much will be that? 12.544. That's how they got this 12.544 in one liner. Is it okay? Just to show you how they got this number, I showed you. Are you able to see that? Check, I'm projecting. Amount payable at the end of 6th year is 12,54,400. That is nothing but we have written as rounded off as 12.544. Yes, sir. Yeah. Any confusion? No. So at the end of 6th year, what is banks telling? Are they asking you to pay 12.54 lakh or what did they say? Since bugger you defaulted, you're supposed to now pay how much? 13 lakh at the end of 6th year. Yes or no? Correct? Yes, sir. Yeah. Okay, check now, sir. Check the board. I'll call this as 1, I'll call this as 2. That means you have to pay cash, no? Cash or check or something you have to give. How much? 13 lakh, correct? Now check, pay close attention to this, sir. Is this loan? Loan, we have a contractual obligation to pay cash. Financial liability. We are giving cash, so cash is a financial asset. That means what are you doing? Financial liability you are exchanging with financial asset under. Instead of paying 12.54 lakh, you are paying 13 lakh. Unfavorable condition. That means what this? That means you are paying extra, no? That extra portion is unfavorable to you. That means will be recorded as what? What is that extra? Unfavorable portion. I'll write as unfavorable portion, okay? Unfavorable portion. I'll write 3 is equal to 1 minus 2. How much will be unfavorable portion? 45,600. Correct or no? Favorable or unfavorable? That means what do you do for this 45,600? That is also financial liability. That's what they asked you in this question. Analyze the differential amount to be exchanged for 1.5. Okay, that differential portion also you have to record it as financial liability. Actually, we don't record it separately. We call this as modification and do it. Fair enough. But it will also be coming under financial liability only. To prove that, I just gave all that. Easy? Now I'll not go through the solution. Hope you are okay with this. If you want to write down, I will just project this. Want to write? Which portion? This portion, loan portion is okay? This portion? Or I can write here exchange under unfavorable position if you want it even better. Okay? Exchange under unfavorable condition, they used to say, no? Exchange under unfavorable condition. Got this? Alright, that's what they have solved also, so I'll leave that. Although we anyway done it, not to leave. Hence, check the last line if you want. Hence, the rescheduled arrangement also meets the definition of financial liability. Unfavorable condition. There's another example for unfavorable. Exchanging financial asset, financial liability under unfavorable condition.
Total 13 lakh will be financial liability.
Can we? Okay, this question we will do. In fact, I want you to do after I cover derivative. Homework. I'll cover derivative in about 2 to 3 days time. Put this on board. Once we finish derivative in that class, after that class, just come back and look through the solution. A very, very simple one. 2 minutes may will be able to solve. Then, but now to solve that I have to explain derivative and we have to go. I don't want to spend my time for that. For the time being. Okay, we'll go in a particular order hence. So for the time being, take that as homework. Question 7, can I go? Target Limited took a borrowing from Z Limited for 10 lakh. That means we have taken a loan. So I'll call it as loan payable. For Z Limited it is loan receivable. So that means it looks like for one company, loan payable means we have an obligation to pay cash. Looks like financial liability. Other company has a contractual right to receive cash. So looks like financial asset. Let's see what they're trying to ask here. From whose perspective they're trying to ask. You are able to get, you are in sync with me? No. Z Limited enters into an arrangement with Target Limited for a settlement of loan against issue of certain number of equity shares of Target. Now they got a little more interesting. They are saying I will not give you the loan. Target Limited has to pay the loan back, no? Correct? Target Limited told I will settle the loan by giving my company ka equity shares to you. I will not give cash. I will give a payoff my company ka equity shares. Okay, no? That means for Z Limited there is no problem. Because if you are receiving, whether you are receiving cash or if you are receiving or if you are receiving equity shares of another company, it is definitely a financial asset. But from the Target Limited, no, there is a problem. If you have obligation to pay, then we have to classify it as financial liability. But we have given equity shares. I mean, should we show it under equity? Here there is a little bit of problem. You got the hiccup? Are we fine? Okay, let's actually, we'll read it. Okay, no problem. For this purpose, the fair value per share to determine the total number of equity shares to be issued shall be determined based on market price of the shares of Target. Underline that words. Underline the word fair value per share and underline the word You have to underline fair value per share and underline based on market price of the shares at a future date. That is the keyword here. Evaluate the definition of financial instrument. From target limited perspective, you can say. Because from Z limited perspective, it is definitely a financial asset, no doubt there. From target limited, there is a little bit of a problem. What according to you it is? You tell me. Initially, we took a loan. We will repay the loan not by giving cash, but by giving our own company ka shares. Now, should I have to show that as equity share capital, or should I treat it as a loan and show it under financial liability? Got the hiccup? So, what do you think? You just think, see if you can come up with an answer, then I'll give you.
It is not to be settled in, it's not to be settled in financial assets.
It's not to be settled in?
In the sense, we don't have to give up our financial assets for settling.
No, they are saying, I'm okay. I'll give. They are okay. You can't contradict me. You can't write an answer, don't do it.
No.
They are okay to do it.
Yeah, they are going to give their shares, right?
Correct. They are giving. Their shares, they can't show it as financial assets. There is a specific restrictions there.
Yeah, so it should be equity.
It should be equity. It's not a financial liability according to you. Correct? Yeah. Okay. Before, actually, I should have taken this question after I had done equity. Maybe after doing the next concept, where next concept is equity only. Then you would have answered it like this. Okay, but I'll cover maybe this as well as the concept together. You want to buy an equity shares. Okay. You went to let's say Reliance wants to give additional shares. They want to come out with an IPO. They fix the range. Okay. Or let's say it's a new issue. Just your reference. I'm giving you this. Okay. It's not related to, or maybe you can write it. It's fine. Let's say, or maybe let's take a simple example. A Limited wants to issue 1 lakh equity shares of face value 10 at 12 rupees, at 12 per share. Okay. Yes, sir. You want to buy now. Let's say you want to buy 100% of this 1 lakh, entire 1 lakh shares. You have money, you're rich, you want to buy it off. Correct? Is this equity? Can company show this as, what is the journal entry will pass for this rather in the books of A Limited? What you used to pass? A Limited, they want to issue, or they got, let's assume that we got application for 1 lakh shares at 12 rupees. You only applied. Okay. What entry A Limited will pass in the books of A Limited? I'm talking. What journal entry? They issued shares. 1 lakh shares at 12 rupees per share. What journal entry will they pass? They got full money. No application, allotment, call money, drama. All the money received in one installment. That means the journal entry will be bank account debit 12 lakhs. Yeah. To what? To equity share capital 10 lakhs. To securities premium. Security premium reserve we'll call it here. So 2 lakh. This is what you used to pass? Yeah. Yes or no? Yeah. Correct so far? Good with me? This is the feature of equity, or one of the features of equity. This here we call it as equity share capital. Instead of that, we'll call it as equity here. Okay. Sometimes when we refer to as equity, equity has two parts. If you remember, I've already showed you balance sheet. Part A pertains to share capital. Part B pertains to reserves and surplus. Is it okay? So now, what is the feature of equity here is, equity share rather is, will this 12 lakh be fixed or it will vary, sir? Will this 12 lakh be fixed? Tomorrow, like after your subscription, they'll say, no, you have to pay 1 lakh more, or that is fixed. That means, can I say consideration is fixed? Yes. Correct? How much of a consideration they are receiving? 12 lakh is fixed. Is it okay? Yeah. And 2, will this 1 lakh shares vary? After you buy, will they immediately say, take 1 lakh extra much? No. That will also be fixed. Yes or no? Yeah. Correct or no? Yeah. This is known as fixed to fixed test. If you want to classify an instrument as equity, this fixed to fixed test has to be compulsorily be satisfied. Meaning, consideration of 12 lakh should also be fixed, and the number of shares that you give also should be fixed. If any of them is varying, that means what? It is not your equity. You are using equity as a currency. I'll tell you that in a bit. Are we okay with this? If any of them is varying, either this 1 lakh is varying or this 12 lakh is varying, either consideration or the number of equity shares. If it is varying, then it will be treated as what? A financial liability. Now this is the concept. Is it okay? There's one more feature of equity I'll cover in a bit. I'll repeat this also once more. Did you understand this? Okay. So for it to be equity, what test I told should be fixed? Should be satisfied? Fixed to fixed test. Fixed means first fixed is what? Fixed is the consideration should be fixed, and as well as the number of equity shares should be fixed. As long as both are happening, then you can call it as equity. Otherwise, you are using equity as a currency. Instead of giving cash, you are using equity as a currency to pay off your obligation. Hence, substance it is not your equity, it's a liability. I'll tell you this, I'll repeat that once again through this example. Okay, so are we fine with this so far? Now first let's test with this example is fixed to fixed test getting satisfied. Okay, took a loan 10 lakh, is that fixed?
Yeah.
You have to repay 10 lakh only now. So consideration is fixed?
Yes.
Correct or no?
Yes.
How are you settling this? By giving away equity shares, correct or no? Now check here, I made you underline, what did I say? We are giving equity shares, I'll read this line again for you. For settlement of loan against certain number of equity shares of target. Correct? That means we are settling this loan not by paying cash but by giving away equity shares whose value equals 10 lakh. That means what? Somehow I have to give, pay attention to me what I'm saying. Somehow you have to pay that number of equity shares whose value becomes 10 lakh. That means in reality you check what is your mindset. By giving something, you have to make sure that 10 lakh obligation is settled, yes or no? Because this company Z Limited will not accept even 1 rupee lesser. Correct or no? Somehow you have to make sure that you have to give him 10 lakh rupees. Either give me debtors, you give me cash or give me whatever, but make sure that I get my 10 lakh rupees back. That is his mindset, yes or no? And for that purpose, what did you say? Can you fix off equity shares now only? Or loan will be settled later date? Hence, what are they saying? For this purpose, fair value of the share is based on market value or market price of the shares at a future date. Based on market price, you will determine how many shares you will give. Because ultimately, you have to give him 10 lakh rupees worth of amount in the form of shares. Yes or no? Suppose the market value, let's say you are settling after 2 years. Correct? Correct? Suppose the market price of one share is 100 rupees. How many shares will be issued?
10,000.
Number of shares will be? One moment. If the market value after 2 years is 100 rupees means how many number of shares will you issue?
10,000.
10 lakh totally you have to give. Value of one share is 100. That means how many shares will you give? 10,000. Yes or no? Suppose the market value becomes 50. Then how many shares will you give? 10 lakh you have to give and the worth of one share is 50. That means what? This will become 20,000. Correct or no? Suppose this becomes only 1 rupee. Then you have to give what? 10 lakh shares. Correct or no? That means is this number of shares fixed or number of shares varying, sir? Vary. For equity, what did I say? What test should be fixed? Both consideration should be fixed and number of shares should be fixed. Is number of shares fixed or not fixed here? It will vary. Why it will vary? Because how many shares you will give, it depends on the market value on the settlement date. I've assumed the settlement date is 2 years and I've assumed the market value. Getting it on? Correct or no? Means think about this. Forget about the by-hearting that. Think logically. Here, are you really giving equity? Now, in this example, you check. Should the company have to worry anything about market value after issuing? They gave it. Okay. If the market value here become 20 rupees in my example, will the company tell you, look boss, you gave me only 12 rupees per share. Now market value is 20 rupees. Give my 8 rupees back. Now what? Because what? That 8 rupees is the return for equity shareholder. Whether the share price goes above 12 rupees or it falls below 12 rupees, is it interest of the company or company will not even bother about it? Yes, that is the feature of equity. There is no obligation to repay cash. Once you do it, it is done. Because equity is an instrument we already studied. It ensures residual interest in the company. It doesn't have any much fair value. Once you pay off, it is gone. But now now relate the same example here. Here is the company worried about market price. Yes, because somehow they have to make sure that they pay what? 10 lakh rupees. I mean, are you not using equity shares as a currency here? If market value goes means you have to pay more cash, buy more shares and give it to them. Correct or no? That means what are you doing here? You are using equity shares as a currency to settle an obligation. That means obligation to pay is always there. In this example, since you are using equity shares as a currency here, it will not be classified as equity, but it will still be classified as what? A financial liability. Or if you don't want too much of logic, just apply simple thing, funda in your mind, fixed to fixed test. For you to classify something as equity, what test should be satisfied? Fixed to fixed. Here is fixed to fixed test getting satisfied. 10 lakh is fixed, consideration is fixed, no problem. But number of shares also should be fixed. Is number fixed or varying? Varying. That means what? That means it is not an equity. It will be still classified as a financial liability. Can we read the solution just to make sure you have got it? In the above scenario, Target Limited, that is the guy who has to pay, is under an obligation to issue variable number of equity shares. That itself is a giveaway.
Yeah.
How will you answer this question is, first you'll call out the definition of equity, which we have not even went through. Okay, first you'll call out the definition of equity, and then you will say, since the number of shares is varying, it is not equity, it's financial liability. That much if you write, it's good enough. There's also one more line here, if you want you can write. What is that one more line I told? You're using equity shares as a currency. So that line, if you want, you can bring in. That is a keyword. Yes. Okay. Since it's under an obligation to issue variable number of equity shares equal to total consideration of 10 lakh. So the number of equity shares is varying. Correct? Hence, equity shares are used as currency for the settlement of amount payable to Target Limited. Correct? No. Since this is a variable number of shares and a non-derivative contract, how is it non-derivatives? Under derivative contract, there will be no physical delivery of shares. You're not interested in shares. You're interested in share ka gain or loss. Under non-derivative contract means there will be a physical delivery. Physical delivery does not mean paper. It could be electronic transfer also. Fine. For a fixed amount of cash, it tantamounts to use of equity shares as currency. Hence, this contract meets the definition of financial liability. Underline that. In fact, you need not write all that stuff. Tell me, how will you answer, just to be sure? If I'll write here, you will first para, you will call out definition of equity, sir, which we're going to study in some time now. Okay? Yeah. That you will call out. Correct? Then you will say here what? Here equity is used as currency. Equity is used as currency here. That point you will bring in. Correct? And you will also say number of equity shares is fixed or varying. Number of equity shares is varying. Okay? Correct? Yeah. Hence financial liability. That's all you can write. Okay, manageable. Definition of equity. Here equity shares are is used as currency. Number of equity shares is varying. Hence it is a financial liability and not equity. Yeah. Too much or okay? Fine, no? Thorough, understood, no? Pakka? No doubt at all. Okay. And this variability also, there are some exceptions which we will read. Okay, it can vary also under circumstance only, not every time. We'll see what are those circumstances in some time. Fine now? Okay. But here you underline this. Here the variability is on account of market price. Yes or no? Keep that in mind here. Okay, it's varying because of market price. That way you will be able to relate later on. Okay. Can I move on? What is the definition of financial instrument? Can you tell me? Just to see how well you remember. Financial instrument, not asset. Yeah. Financial instrument is a contract, correct? Yeah. That either results in financial asset for one company and either financial liability or equity for another entity. I mean, financial instruments cover only three concepts. Yeah. Financial asset, financial liability, equity. Financial asset, financial liability already done. I mean the last one, equity. Equity also we have already tested, yes or no? Yeah. Okay, in equity they have given huge thing. I'll give you a notes, just write down those points, that is sufficient. Okay. First point, I think we can take them. I think we already know this. What is equity share? I already told you this yesterday. Tell me, what is equity?
Equity is the...
What is equity? Don't look at the book. We already saw this. Yeah. Equity is an instrument that entitles residual interest in the net assets of the company, or it's an instrument that entitles in the assets of the entitles the right of over the assets of the company after deducting all the liabilities. Meaning, what if company liquidates? First you will sell the assets, pay off all the liabilities. If still any money remains, that will be given off to equity shareholders. That is what this is a definition. Is it okay? Yeah. So that is your equity first definition. It's basically a contract or an instrument that evidences or that gives, if you want you can just write here, that entitles or gives residual interest in the assets of the company after deducting all the liabilities. Or you can just write, it ensures residual interest in net assets of the company. Net assets means, how do you get net assets? Assets minus liabilities only, no? That way also you can construct the definition. Easy now? That is the first definition. Okay, they've given too much, okay, here. So we'll not worry about that. I'll just give you this features, right? This first point is this only for equity. Remember this first point, meaning of equity. Then features of equity. First, no contractual obligation. write this. It is not, it's there in your charts. Okay, but book may they have given two things, and I'm just summarizing that. Okay, no contractual obligation to deliver. Deliver means pay. No contractual obligation to deliver or pay cash or other financial assets. Is first point making sense? Or maybe we'll write off and then discuss. You'll be busy in writing only that.
Yes, sir.
Generally non-puttable instrument. Non-derivative contract. Equity means it's a non-derivative contract. Non-derivative contract where consideration and number of equity shares is fixed. This only we call it as fixed to fix test. These are some features. Remember this, that is good enough. Okay, because this life and reviews actual standards, it's fine. Leave that portion. Fine now. Just know this is good enough, and all this has been brought out in charts also.
Okay.
We'll look at the features and then we will kind of take it up. Fine now. First, meaning is clear.
Yeah.
So equity is an instrument that gives you only what? Not the total assets. It only gives you residual interest in the net assets of the company, or residual interest in the assets after deducting all the liabilities. That is one. Two, it should not have any contractual obligation to deliver cash or any other financial asset. Okay. Equity means the company, if the company gives any equity shares, they should not have a contractual obligation to either give cash or any other financial asset. Take this example only, or maybe here, company issued 1 lakh shares, correct? On this 1 lakh shares, is company required to buy them back?
No.
You purchased 1 lakh shares, correct? You paid how much to the company? 12 lakh rupees because you purchased at premium, correct? Yeah. Does company have any obligation to repay that 12 lakh rupees to you?
No.
Equity shares means we call it as permanent capital because there is no obligation to repay. Yes or no? If the company wants, they can do buyback accounting. Yeah. But is there any obligation compulsory that they have to pay your money back? No. They say if you want to buy, you sell your shares in the trade market and recover your money, share market, correct? No. But does the company have any obligation?
Yeah.
Yes. No obligation to repay the money, correct? No. It's not just obligation to repay money. They should not give you any other financial asset also.
Okay.
Meaning they've taken 12 lakh from you now. They should not have an obligation to give up machinery. Okay. Not machinery. We'll take it as what, equity shares of some other company. They have equity shares of, let's say, Infosys. Because you purchased their shares, it should not be like they should give away their investments. Correct? Then basically no obligation is there on equity share. Remember that. If there is obligation, then it is a financial liability. Yeah. Correct? If there is no obligation, then only you'll think on equity lines. Fine now. That is the first pointer. Is it comfortable now? Yes. Are you comfortable? 100%? Yeah. Okay. What is the second feature? This we'll take it up later. What is puttable, non-puttable? We'll take it later. Next concept that is. Okay. Leave that. Okay. Third is what? A non-derivative contract. Non-derivative contract means what? It involves physical delivery. Yes. Has physical delivery, if you want you can write in layman term. Has physical delivery. Generally, derivatives don't have physical delivery of instruments. We are only interested in gain loss related to those instruments. So, non-derivative contract it should be where consideration and the number of equity shares is fixed. This is what you will remember. These 2 points are very important for your case, sir. 1 and 3. You will be quoting them and writing in all the most of your case studies. Fine now. What is the third one? Did you understand? Third one we already discussed, no? For you to call something as equity, 2 components has to be fixed. What are the two components? Consider fixed to fixed I'm talking about. Consideration should be fixed as well as number of equity shares should be fixed. This only we call it as fixed to fixed test. Yeah. So for you to classify an instrument as of equity, that fixed to fixed test has to be compulsorily satisfied, and we should not have any contractual obligation to pay cash or any other asset, any other financial asset. Got it? Fair enough. In the previous example, this failed. Yes, sir. Hence, it is not equity. Okay. Manageable. So you can leave all this portion out and just remember this portion. That is good enough. Fine. Don't worry about other things. I've just summarized it for you. Some more is there, I'll bring them later. Now, if you have understood, I think, is it okay? Can we do a few problems?
Yeah.
4 more problems are there, that equity will be done, and then we can go for puttable instruments.
Yeah.
So then we can take a break, that's fine?
Yeah.
Okay. You want to recap?
No.
It's fine?
Yeah.
Okay. So, question number 8 will start?
Yes, sir.
Okay. Silver Limited issued irredeemable preference shares. Underline the word irredeemable, sir. Whose face value is 10 rupees at a premium of 90. That means the consideration is 100 rupees per share they are receiving.
Yeah.
And it's irredeemable. Okay, sir?
Yeah.
Alright. These shares carry a dividend of 8% per annum.
Okay.
Normally, preference shares dividend is fixed, no? So they're saying 8%. However, they are saying dividend is paid only when Silver Limited declares dividend on equity shares. Unless the nature of this instrument. So one, you don't have to pay the money back because it is irredeemable. They didn't say anything about conversion also. They only said what? Irredeemable. That means what? This is perpetual preference shares, can I say?
Yes.
Meaning it just goes on. Correct? Yeah. On this perpetual, I'm going to give you dividend at what rate? 8%. Yes or no? Yeah. But they brought in one more bomb. What is that one more bomb? I will give you dividend provided if I pay dividend to equity shareholder. If I don't pay dividend to equity shareholder, no dividend to preference shares also. Yes or no? Now you think they have called preference shares, but Ind AS runs on substance over form accounting. You may call anything, but we have to know in reality what is the nature. Now you tell me the reality of this instrument is what? Now we don't have any category known as preference shares, sir. Earlier you have preference shares. Now preference shares either has to be classified as equity or it needs to be classified as financial liability. Okay? Now you have to tell me whether this preference shares is an equity or a financial liability.
It's equity.
Equity. On what grounds are you saying it is equity, sir?
Fixed number of shares, fixed consideration.
No, that is only for, okay, fine. Fixed number of shares. Consideration is fixed. At initially it is fixed. Okay.
Then right over asset would be there for preference share also.
Right over, only equity instrument has a right over residual interest. Preference shares don't have right. Hence the name is preference, no? Why are they calling it as preference? They have preference over equity shareholders. Yeah. In terms of two things we said generally. Dividend declaration and in the time of liquidation, preference shareholders get their money first. And then only you pay equity shareholders. Yes or no?
Yeah, correct. They get the money first.
Yeah, they do, yeah.
And that is from net asset.
Okay. Okay, like in that sense we can't say. That doesn't mean that they have residual interest. Residual interest means what? Something which is remaining. Yeah. To bank people, can you say I'll pay you what is remaining? I'll pay everybody first and then I'll pay you? No. So means there is an order, yes or no? If you have 10 lakh rupees, 5 lakh rupees preference shares you have, 10 lakh rupees equity shares you need to pay. You have only 10 lakh rupees with you. Will you pay off the entire 10 lakh to equity shareholders and pay 0 to preference shares? No, first you'll pay out to preference shareholders. Then balance equity shareholders are getting. I mean, who's getting residual there? Equity shareholders. Correct. Now that's what we mean by residue. Residue means whatever remains you will get. Okay, after paying everybody. That is what we mean by residue. Residue, that way everything is paid out of net asset only. But think on these lines. Think on the features. What are the features I gave there? Yes. From that perspective, you are right. But think about features. I gave you features just for that reason. No? One, do we have any obligation to deliver cash here? No. Dividend is there, but should we have to pay dividend? If I don't give dividend to equity shareholders, should I have to pay dividend to what? Preference shareholders? No. Not necessary. That means, do we have any obligation? I don't have obligation to pay dividend also. I don't have obligation to repay that capital also. Because it is irredeemable. Means for the name's sake, it is preference shares. In substance, this is also in a way what? Equity only. So classification will be equity. In the case of liquidation, since it is preference shares, these guys will be paid their money first. Okay. Liquidator will pay their money first to these guys, and then only other equity shareholders will be paid. Okay. From accounting per se, this is equity only. Yes, you are right in saying so. Are you comfortable with that? Or now I told extra and you brought in confusion. Yeah. Just two features. Don't worry too much about it. Equity means two features. What are those? No obligation to pay cash. Cash could be what? Dividend or principal repayment or capital repayment. Correct? Do we have that here? No. No obligation to pay dividend. No obligation to repay even the principal of capital borrowed. Yes or no, sir? Yeah. Correct? Yeah. These two features. Correct? That is good enough. Fixed to fixed, it's fine. That is also anyway, it's not varying. When you issue, every instrument is fixed only. When you are giving away preference shares, obviously number of preference shares is also fixed, value is also fixed. So that test need not be applied at the time of issue. because it has to be fixed. Otherwise, how will you do the accounting? Correct? No. Even if you say it is based on market value, you have reached that day. That means you know already market value. I mean, even then it will become fixed. Fair enough. So you don't have to apply that test. Those tests has to be applied for contracts which will be settled in future. That fixed to fixed wala. Are we okay? That means what is the nature of this now? Analyzing the definition of equity, this meets the definition of equity. Got it up? Which definition they're saying? In fact, maybe we'll read out the solution. Two main characteristics of preference shares in this problem is what? Preference shares carry dividend, which is payable only when the company gives dividend on equity shares. That means they can escape. Obligation means they can't escape. They have to pay. Here, can they escape? If they don't pay dividend on equity shares, they can easily escape from this. That means they can escape. If you can escape means there is no obligation. No. If you had seen the revision video of Ind AS 37, you'll know this. I had mentioned this. Obligation means no escape, pet name. If you have not gone, no problem. Anyway, we have to do it, we'll do it in some time. Fine? Obligation means think that no escape. Okay? Here, no escape scenario, or you can escape. You can escape. That means there is no obligation. Fine now? And preference shares are irredeemable. That means we don't have any obligation to pay capital, principal, or face value of that capital back also. Hence, it meets the definition of equity. Done now? Suppose they are told compulsorily dividend. Then it has features of both equity and financial liability, because you have an obligation to pay dividend every year 8%. Correct or no? That means that has a features of financial liability. But face value of capital you need not repay. That means that has a features of equity. Such instruments we call it as compound financial instruments. Little later. Okay, that could also be possible. Maybe I thought some of you may be having that doubt, hence I sorted it out. Fine, now we'll cover that little later, not now. Now how accounting works, we will see.
So in feature of equity, no contractual obligation to pay or deliver cash or financial asset. Is that applies for interest also?
Which one?
Dividend also.
Yes. Did we say, when I say cash here, that cash includes what? Interest, dividend, everything. Whatever you're paying. Principal, interest, face value of capital, everything. It is cash. Cash means everything, no sir? We should not have an obligation to pay off. Equity shareholders also know. So you think, sir, if you purchase any company ka equity shares, compulsorily you will get dividend every year? No, if company wants, they will declare the dividend in year 1 and they will give you. Year 2 they may choose. I will not pay the dividend. That means, do they have obligation? No. If they want, they will pay. Otherwise, they not pay. That is the feature of equity, or that should be the feature of equity. There is no repayment at all. Company, once they issue equity, no, it's like relaxed. Like our classes, whether you understand or not, just sit back like that. Okay, and the company should not have anything on their head that I have to give this. If you take a loan, compulsory you have to give interest and principal back. Equity should not have any of that features. Chilled out person is. Tagombadi, marthbadi. It's like forgivable loan. Take and forget. Okay, something of that sort. If shareholder wants it, let him go to the share market, sell the share and recover the money. If company wants, later they will do the buyback of shares. That is their mercy. There is no obligation. Fine. Can I move on?
So, what if there is a loan which is structured in such a way that only if you make profit you will have to pay interest?
We'll see. Next it's there, correct? We'll see. Such instruments actually, there again, you can call it. They say if on liquidation, if you're getting residual, if you structure an instrument that you'll only get the money on liquidation, that to prorated share of net assets, and such instruments also in reality becomes equity. But if you're making any periodic payments to them like interest, then that portion will be considered as financial liability.
Only that portion.
Like that. Wherever you have obligation, that obligation portion is financial liability. Other portion is equity. Like this, an instrument can have features of both. That we call it as compound. We'll cover. Let's not go to compound for the time being, because others will not understand. It's like, it's there. Don't worry. It will come just maybe tomorrow's session, or if possible, we'll cover it today. We'll see. Not very sure. Done now? Okay. So hope this question ka solution is clear for you. It is equity. Can I go for the next one? Ninth one. In fact, last line you can underline. Hence, preference shares meets the definition of equity instrument. You don't have to write all that they've written. Okay. You'll just write what? Features of equity. Okay. 2 features of equity you'll write, or 1 feature in this problem is good enough. Okay. And then you'll call out the case. In the present case, no obligation to pay dividend, no obligation to repay capital as it is irredeemable. That's second para. Final conclusion, equity. Classified as equity. That much you'll write. Don't have to write all this. They have written like para and all. This is a study material solution. Fair enough. Hence, I'm giving you the features and all. You can make it. Fine, no? Can I move on to the next?
So, this dividend which is declared, is that financial liability? Dividend which is declared by the company, isn't that a financial liability?
Which one? I will have to see. If an instrument is classified as financial liability and if you paid dividend on that dividend you have to account it as interest and it will come in P&L.
Okay.
If you classify, if a debenture is a financial liability, but that debenture if you classify it as equity because it has equity features, the interest that you pay on that debentures now will be treated as dividend and you have to do dividend adjustment. Welcome to see a final Ind AS. Substance over form accounting. You can call interest, you can call dividend, whatever you want. We run only by the substance. You might be calling it as interest, but in substance, if it is dividend, you have to give dividend accounting treatment to it. Like that. Is it okay? All this is there. We'll see. We just started the topic now.
But equity is anyways equity only.
What equity mean?
I mean, I'm asking the doubt is that normal equity share pay we are giving dividend. So anyways it's dividend only. You don't have to worry about.
You don't have to worry about that. Yes.
And it is declared, so which means you have to pay cash. So which means
it will be done in SOCI. Statement of changes in equity you had. That it will not come in P&L account. That adjustment it will be shown just dividend to bank.
Okay.
It will be adjusted from retained earnings.
And as at year end, if we have that liability,
we don't do that. That accounting is no more there.
Okay.
We only do dividend accounting when it is declared.
Yeah.
Proposed dividend are not accounted. They are only disclosed now.
Yeah. So on 31st March is declared.
Declared means you do the accounting.
So which means you showed us financial liability.
You just showed, you don't show it as financial liability, you do it for dividend because you're paying it to equity shareholder, no?
Right.
You're saying if you're transacting, if a company is doing transaction with members, that should be shown under SOCI only, statement of changes in equity. It should come under equity only. It will not come as financial liability. It will come as that. Anything which is related to equity, if you are paying, that adjustment will be done in equity only. Okay, that statement of changes in equity, you will see that. When we do consolidation, I'll take it up. For time being, I think we'll be moving off topic. It will come in, just to answer your question, it will come in statement of changes in equity. We had two portions of that. First portion is equity, second portion is other equity, which we refer to as SOCI. It will come there. Okay, just put that on hold. In consolidation, fine. Can I?
Yeah.
Okay. Excuse me. A Limited invest in compulsorily convertible preference shares. Underline that, sir. Compulsory convertible. I mean, do we have any obligation to repay their capital?
No.
Because we're going to convert it into equity shares. The moment this is preference shares, but we're going to convert it eventually into equity shares. The moment you see convertible preference shares, what should click into your mind? No obligation to repay is there. You should always think on the lines, can I classify it as equity and test the features of equity? Are you converting now or conversion will happen later? But for features of equities, number of equity shares should be fixed. If the conversion of number of equity shares is fixed, then it will be classified as equity. If it is varying, then you are using equity shares as a currency, hence a financial liability. Getting it up? Are you able to get the concept? Can I read this further and reconfirm what we just went through? Can I? Yes, all right, you. Compulsory convertible preference shares issued by subsidiary limited, B Limited. They invest. A Limited is investing in B Limited ka preference shares. Okay. Face value is 10 rupees. They are giving it a premium of 990 rupees. Hence the consideration is 1000 per share. Under the terms of the instrument, each CCPS, that is compulsorily convertible preference shares, is convertible into one equity share. Perfect. Underline that. Into one equity share at the end of 5 years. That means what, sir?
That means it is into fixed.
Means we have a fixed to fixed test is getting satisfied.
Yes.
Correct or no?
Yes.
Such CCPS carry a dividend of 12% per annum, payable only when declared at the discretion of B. That means what? If they want, they can pay dividend, or if they want, they can escape.
Yes.
That means, do we have any obligation to pay dividend here?
No.
That means it has all the features of what? Equity. That means what? This instrument will be classified as what? This instrument will be classified as equity in the books of B Limited. Okay? Because the conversion is into fixed number of equity shares. You'll just write the features of equity shares, correct? What are the two features we wrote already? There is no contractual obligation to deliver cash or other financial asset. Yes or no?
Yeah.
And conversion is happening at fixed number of equity shares.
So, but till
Fixed
it's
to fixed.
converted, we have to pay interest.
Now only. You don't have to pay interest. You have to pay dividend. And dividend also there is no obligation. If they want, they will pay. Otherwise, no. See, every instrument will have something, sir. If you have equity shares also, you have to pay dividend. That does not mean that dividend portion is financial liability. See, what is financial liability is, no matter what, you have to pay it. Meaning you can't escape from it. Here, can they escape from it? If they want, they can choose not to declare the dividend and not to pay. Correct or no? So that means you don't have to think that this is a financial liability. Are we fine? So you just,
What if till the conversion date, it acts like a normal preference share, you get a fixed dividend?
That portion means then, you'll have to see. dividend portion, you have an obligation to pay them because you can't escape from it. You have to pay every year. That portion is financial liability portion. And principal you don't have to repay. You will only convert. That portion is your equity, compound financial instrument, because has features of both equity and financial liability. I'm using this term CFI, compound financial instrument, often. We'll be doing a lot of problems in this. Don't worry. Okay, we have enough number of problems. We'll cover it. Done now. Don't have to worry anything about accounting for the time being, sir. If you just check from the start of the class, we only discussed 3 things: financial asset, financial liability, equity, and that too meaning of them. That's all. I want you to restrict your thinking only to that. Accounting, don't worry. Next, we'll take it up. Fine. One step at a time. Because this is not your conventional accounting. If you just think, no only you did like all this year. In your PSC, somebody told preference shares means easily you would have passed entry. Preference shares account, bank account debit to preference shares, or to security premium if it is issued at premium. If company gave debentures, did you think that it could also be classified as equity? Never. Yeah. So yeah, this, since it runs over substance over accounting is slightly different. So if you think, your thinking will be on the lines of PUC approach. It will not work out here. Hence I'm saying don't worry about accounting. Leave it. We'll learn it afresh. Think that you are learning it for the very first time. Think that you've become like an accounting journal entry and you're learning it for the very first time. That way you learn this financial instrument. It will be less confusing. If you start comparing, then it will be like, what is happening? Your scenario will be created. Done now. Move on to the next. A Limited issues warrants. Share warrants they're giving. Okay. To all the existing shareholders, entitling them to purchase additional equity shares with a face value of 100 per share at an issue price of 150 per share. So we have given some warrants to the existing shareholders. It's a document basically. Okay. So what does this document entitle, or what does it give? If they want, they can buy more shares. Correct? Yes. At a fixed, whose face value is 100, but they have fixed the price 150 rupees. Correct or no? Is it varying or fixed, sir? Fixed. No, whether market price is 150, 200, 300, 10 rupees. Warrant ka price is fixed. Correct or no? Share warrant means obviously they will tell how many shares also you can buy. Just like that, they can't give warrant. Here warrant take. Can they give it? Obviously they will tell you. Here they have not defined. Normally share warrants will have that feature. Okay. You can, one warrant is equal to 100 shares. Like that. So that means number of shares also will be ideally fixed. Which they have not typed here. It should have been typed. Fine now. So that means what? It has what features now? Equity. Because what? Which test you will apply? Fixed to fixed test is applied. Consideration is also fixed. Consideration is 150. Correct. And the number of shares, though they have not given, will be fixed because there is share warrant. Done now? Hence what will be the classification? Equity. Okay. But if you don't want equity, if you are only interested in gain or loss, then it becomes derivative. They have solved the question keeping derivative in mind. Leave that. For now, you just treat it as equity. Then when I do derivative, maybe this question also you can read it again. I will not read it for the time being. Okay? We'll see. They can. We'll see. When we do derivative, we'll come. First, we have to know features of derivative. No, we have not yet come to that. Once you know the features, come back to this question, read it, you'll understand. If there is physical delivery happening, it is not a derivative. If the shareholder says, I don't want your share. Now, share price has become 160. I can buy it from you for 150. That means 10 rupee gain for me. You give me only gain. Then it becomes a derivative. Then you have to do some other accounting for it. Since we have not discussed, I will not go through that. For now, I can only say what this is an equity instrument. Are we okay? It is equity. Fine. If it also has derivative features, then you'll have to do derivative accounting for it. Done now? I'll not go there. Okay, couple of more questions now, and then next concept. Take a break and resume. Fine now? Patapat will do now. A Limited issues preference shares to B Limited. Those preference shares are redeemable. Underline the word redeemable. That means what? We have an obligation to pay cash. Okay. From the date of issue, and entitles the holder cumulative dividend of 15%. That means dividend also you need to pay. Correct? Rate of dividend is commensurate with the credit profile of the issuer. Means they're saying the rate is correct. True rate. No manipulation. Examine the nature of financial instrument. We have an obligation to pay cash. Correct? No. Once you have the obligation to pay cash, obviously it is a financial liability. Yes or no? Check the last line. I mean, how will you write if they ask for 2-3 marks? Financial liability ka few features you write an answer. 1 or 2 features you will write. Only one feature you definitely have to write, which is what? Here we have an obligation to pay cash. One of the features for financial liability is that that instrument has an obligation to pay cash or any other financial asset. Here we have an obligation to pay cash, correct or no?
Yes.
Hence it's a financial liability in its entirety.
Yeah.
I mean, entire thing. This is not CFI, meaning it is not a compound financial instrument. Done, no?
Yeah.
Next one, Hogana.
Yes, sir.
I'm not reading the whole thing. I think now you are comfortable.
Yeah.
P Limited issuer takes a loan from Q.
Okay.
The loan is perpetual. Perpetual means what? Do we have an obligation to repay the principal?
No.
No, it goes on forever. However, you get an interest rate of what? 8%. Examine the nature. Principal portion, do we have to repay?
No.
There is no obligation to repay principal portion. But we have an obligation to pay interest portion.
Yeah.
That means interest portion is what?
Interest
Portion is financial liability. Principal portion we have to classify it as equity. Compound financial instruments. Done now? They have broken it down. It has two components: mandatory interest and perpetual nature of principal. Okay. First component, that is interest portion, we have to treat it as we cannot avoid it. Hence, this instrument or this portion is financial liability. They have only answered from interest portion, and they are calling that interest portion as financial liability. Easy. Okay. Let's have a 2 minutes quick recap, and then we will take a break and resume. Fine now. One, financial instrument. Now what is financial instrument?
So, but this interest will actually, I mean, they'll adjust the principal portion also into that.
Not necessarily. Perpetual means yes.
Yeah.
Again, how to do the accounting, don't worry. That's what I'm saying. There is a specific way. We'll see. What you're saying is thinking on the right lines, but don't worry about that at all. When I do compound financial instrument, think on those lines. You'll get it rightly. Otherwise, unnecessary, you'll bring in too much hula into your brain. Okay, it'll spoil the topic for you. It'll freak you out. Aram se, one at a time. Think first time. Don't overthink at all. Don't think the next step. Think only about this step. Did we understand this? Next step when we do, then you do cumulative approach. Write that doubt. If you have a doubt, I'm not discouraging you. Write that doubt down. Write it down. Tomorrow you compare, the doubt will not be there. You'll only cancel it off. Okay, it's like this. It's a step-by-step process. Hence, you will have a lot of doubts. I don't worry about that. But just restrict a little bit is what I'm saying. Fine? Not discouraging. Hope it's okay, no?
Yes.
Yeah. Alright. Financial instrument is what now? Basically, it should be a contract.
Yeah.
Which gives rise to either financial asset to one entity or financial liability and equity to another entity. Are we okay? Can I bring in one more point now? If you remember one thing I had not covered here. We have income tax refund, advance tax, provision for tax. Are they financial instruments?
Refund, if it is sure that it will
They are processed.
then it is financial asset.
Advance tax paid.
We get that.
Provision for tax.
That is our own provision.
Our own provision, no outflow.
No, I mean, not
One, don't have to worry about it all. First, the very meaning is very important. Financial instrument is what? It's a contract.
Yeah.
Do we have any contract with Government of India?
No.
Hey macha, I will pay you this much tax, that much tax.
No.
That means it's income tax obligation. It's an obligation, no doubt. Is it arising as part of contract?
No.
That means they are not under the purview of financial instruments. We have a separate Ind AS 12 income tax. There will be it covered. They are not financial instruments for this per se. Is it okay? Anything which is not contractual, anything which does not arise as part of contract is not financial instrument. There has to be a contract for you to call something as an instrument as financial instrument. That is one more point. Now is it okay? Are we fine?
Yeah.
You remember what is that? Constructive obligation. We don't know. Okay. Obligation can be two types. Maybe because of this, I'll spend 1 minute on this. Okay. Or maybe 1 moment. Hang on. I'll do of this and then come to that. Or we'll have a recap and then come to that. Financial instrument means what? It should be a contract, and that contract should give rise to either financial asset to one entity and financial liability or equity to another entity. Yes, sir?
Yeah.
Now, features of financial asset. What are the features of financial asset? One. What are the features of financial asset, sir? Financial asset means it should be a cash, including bank deposit, or it could be equity instruments of an other entity, or it could be a contract to receive cash, contractual right to receive cash or equity shares of another company. Yes or no? Or other financial assets. Correct? Or it could be a derivative, or it could be you are receiving variable number of equity shares. Again, I'll put that on hold. I think didn't cover that. I'll come back in a bit. Okay. Are PPs are tangible assets, intangible assets, goods, financial assets? No, because by using them you can generate inflows. By holding them, can you generate the inflows? No, that means they are not financial assets. Done now?
Yeah.
Prepaid expense? Prepaid salary?
No.
Prepaid salary paid to employees? No, because what you get in return is a specific service. Advance paid to supplier? You have a right to receive the goods. So which is not a financial asset. Done now? Okay, so next we saw financial liability. What is financial liability? Should we have to go through the definition, or we can construct? Take out the first 2 points of financial asset. Remaining last 4 will come.
Yes.
Here it is not a contractual right to receive, but here it's a contractual obligation to pay cash or any other financial asset, or to exchange financial assets or financial liability under there under financial asset it is a favorable condition. Here it will be unfavorable condition. Yes or no?
Yeah.
Or derivative, or you are getting variable number of equity shares. I think now we can take this point. A non-derivative contract in which entity is obliged to deliver variable number of equity shares. I told you, for you to classify it as equity shares, fixed to fixed should be satisfied. That means the number of shares should be fixed. If it is not fixed, it becomes financial liability. That is what this point is.
Okay.
If you are giving, it is a financial liability. If you are receiving, financial asset. Are we okay?
Exactly.
Like if this example only, right? We saw now, where is that? Which example did we spend our time on?
That fair value.
This loan. Remember Target Limited, Z Limited ka. We took a loan. Are we repaying that loan in cash or through shares?
Yes.
Shares. Ideally, it looks like equity, but why didn't we classify it as equity? We classified it as financial liability. Why? Because the number of consideration was fixed, but the number of equity shares you gave was not fixed. It was variable. For you to classify it as equity, it has to be consideration also should be fixed. Number of equity shares also fixed. Yes or no? Correct? If it is not fixed, then what do you have to do? If you can't classify it as equity, what will you classify it as? Financial liability. If it is financial liability for you, other companies receiving, no. The other company will be financial asset because they are receiving variable number of equity shares. Are we okay? I put that on hold. Now, are you okay with this? Because if I told then no, you would not have understood. Now I think it's okay. Correct? Any confusion now or okay? No confusion. So that means financial liability portion also we covered. Only one portion is remaining, which is what? Equity. What are the features of equity we said? What are the features of equity we wrote, sir? Where did we write? Where did we write? Here. Equity means what? First of all, meaning of equity is what? Oh, you're writing something, huh? Finish. It's okay, no problem. Online guys also can write something if they want.
The right to get a variable number of shares is financial asset.
Correct. If you are giving your own company equity shares, if it is variable, then for you it will be financial liability. Correct? No? For this target, I think you're still confused with this, huh? Okay, maybe I'll take that one moment. Target, no? This company. Look, Target and Z Limited. Yes or no?
Yeah.
Target has taken a loan.
Yeah.
I mean, Target is giving equity shares.
Yeah.
Giving own equity shares. Own equity shares they are issuing, but is the number of equity shares fixed or variable?
It's variable.
Since this was variable, we classified this as what? A financial liability. Yes or no, sir?
Yeah.
Suppose this was fixed. Since consideration is also fixed, and if number of equity shares also by chance was fixed, then this would have been classified as equity. Are we okay? Correct, no, sir?
Yeah.
Now think, you are giving, who's receiving it?
Z.
Z is receiving, correct or no?
Yeah.
Now from Z perspective, are they receiving fixed number of shares or variable number of shares? Now here they are receiving variable number of equity shares. Yes or no?
Yeah.
Correct?
Yeah.
Yes?
Yeah.
Hence, because they are receiving equity shares of another company, no? Whether you receive fixed number of equity shares of other company or variable number of shares of other company, it is still a financial asset for you. Got it? Fair enough. In fact, it is same like point number 2 only, but just they bought an extra. Done. Now is it okay?
Yes, sir.
Did you understand the meaning of that now? Now that we had put out that point for which we had put a question mark. Don't be misled by the word own equity instrument. They are not receiving their own equity instruments. Somebody is giving their own equity instruments which we are receiving. Here own instrument means target instruments received by Z. For target it will be either a financial liability or equity. For other company it will be a financial asset. Even though it is variable number of equity shares, still it will be classified as financial asset. That is what they are wanting to say there.
Yeah.
Got it? Now coming back to equity. What is equity? Meaning of equity is it's an instrument that gives you a right over net assets of the company, correct?
Yes.
And what are when can you classify it as equity? Two main features of equity should always be present. One is what? There is no obligation, because the moment obligation comes, it is financial liability, yes or no? So no obligation to pay either cash or any other financial asset, correct? That should be done. One is that, and correct? If you are not giving equity shares now, but down the line, no problem, that also can be classified as equity right now, provided fixed to fixed test is getting satisfied. What should be fixed? The consideration that you are receiving should be fixed now only. The number of equity shares that you want to issue, that should also be fixed. If one of them is variable, if either of them is variable, then automatically it will be classified as financial liability. Got it? Generally, these equity shares are non-puttable, which we have not yet covered. Let's put that on hold. That is the next concept only. Okay, na? Alright, now let's take a break and resume.